Hello, I'm Darine Abougaida. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, saving China's economy, the government has announced a 33-point stimulus plan to boost economic growth. Is it enough to correct damage caused by COVID lockdowns, or is a slowdown around the corner? Also this week, the contentious Northern Ireland Protocol. The UK plans to scrap parts of the post-Brexit trade deal with the EU, but can it do so? And how will businesses be affected? And the tourism industry has had a strong start to the year despite rising prices. But is its recovery sustainable, or could the war in Ukraine hamper the rebound in global travel? It's been the biggest source of global economic growth for the past 20 years, and China has long defied predictions it would soon hit a wall. But strict COVID lockdowns, a crackdown on tech companies, and a real estate slump are challenging the world's second largest economy's expansion. So many financial institutions predict growth will fall well short of Beijing's target of around 5.5% this year for the first time in decades. So Beijing has announced a 33-point stimulus package in an attempt to boost economic growth. The measures include loans for small businesses and airlines, cheap mortgages for first-time home buyers, and subsidies to help people buy electric cars and laptops. The plan also includes big spending on infrastructure. And China has turned to state-owned policy banks to provide more than $120 billion in funding for the projects. Well, official data on industrial production, retail sales, and fixed investment revealed the economy slowed sharply in April. But the Chinese economy showed signs of partial recovery last month. Industrial output increased 0.7%. That's slightly higher than expected. But retail sales remained weak. And the government is persisting with its zero COVID strategy despite its impact on businesses, as Katrina Yu reports.
Beijing authorities say they're racing against time to contain a ferocious resurgence of COVID-19. Less than a week after the capital eased virus restrictions, hundreds of new cases have been identified, all linked to this nightclub, Heaven's Supermarket. Its business license has been suspended, and the owners are under investigation.
Police have launched a criminal investigation into the bar and the relevant people in charge of the bar on suspected interference with epidemic prevention.
Several other people have been charged with breaking COVID rules, including 3 men who ignored orders to isolate at home. The cluster has spread to 14 of Beijing's 16 districts and prompted mass testing in the largest, Chaoyang. The reopening of schools has been delayed.
Heaven's Supermarket Bar is located here in Sanlitun, an area of Beijing known for its nightlife, restaurants and shopping. These businesses had just reopened when this new cluster was found, and now hundreds of them have had to close their doors again until further notice.
Dozens of cases have also been recorded in Shanghai, forcing tens of thousands of people back indoors. The commercial center emerged from a strict 2-month lockdown at the beginning of June. New economic data shows China's zero-tolerance approach to the pandemic is continuing to take a toll. In May, industrial output rose 0.7% compared to the same month last year, and property sales improved slightly. But retail sales fell 6.7%, with uncertainty weighing heavily on consumer spending.
It is so incredibly susceptible to faltering the moment there is even a slight, COVID outbreak or a COVID scare even, that I think consumption is going to remain under severe pressure. And that is the biggest economic challenge for the party right now. But righting that is going to take a lot of effort, and that is going to mean a drastically different COVID policy than the one that we have in place today.
Analysts say as long as China's leaders refuse to live with the virus, sustained economic recovery will be difficult, leaving business owners anxious, knowing they could be one COVID-19 case away from closing their doors.
To discuss all of this, I'm joined now from Hong Kong by Jack Siu, who's the Chief Investment Officer for Greater China at Credit Suisse. Jack, welcome to the program. Thanks for joining us. So, do you think this 33-point stimulus package announced by China is actually enough to bring the economy back on track?
It will be one of the major supportive factors that will bring the economy back on track. When we look at this 33 stimulus packages, the most important one is being the special purpose bond issuances. And when we calculate the amount of bonds that needs to be issued, which would be 1.4 trillion renminbi in the month of June, versus in the last 5 months, about 1.8 trillion that's been issued. In a single 1 month, you're issuing about 80% what we've seen in the last 5 months. And that money will have to be deployed into work by the end of August. And when we calculate and compare this with the stimulus back in 2008, where they announced 4 trillion renminbi during the global financial crisis, the monthly spending is even higher than that 4 trillion that was spent over 27 months. So we are quite optimistic about the infrastructure that to be built from these money. And also, on top of these 33 measures, is the balancing of zero COVID with the economy that has been changing on the ground. And also because the regulatory crackdown that's pausing currently are all supportive factors for China's growth momentum going forward.
All right, hang on a second. Let's drill down. All right, let's drill down on some of these points that you raised. So let's look at the infrastructure spending that you mentioned 2008 just a moment ago. So by increasing infrastructure spending this time around, China is in fact using the same tools that pulled it through the financial crisis a few years ago in 2008. Are they effective now as they were then?
They were quite effective in bringing the economy back into a growth trajectory. You know, China have 3 major pillars of growth: infrastructure, real estate, consumption, industrials in general, right? And infrastructure has always been effective in stimulating the growth momentum, and I guess also bringing construction workers back to work. And we think this time around, it will give us fairly good confidence that infrastructure build-up in the coming years will likely lead to a reacceleration of growth in the second half. I mean, alongside the next few years, obviously in the short term, this is good news. In the medium term, now we have to look in the decision of local governments. When they got this money, how are they going to spend it? Where are they going to build infrastructure? And will they be building infrastructure that's very useful for the economy, or ones that may have lower utility? And that's where the medium to long-term question will come in.
Right. Okay.
But for now,
interesting point,
for markets, we should be happy with this.
Let me ask you how China is going to pay for the new stimulus. And does this, in fact, mean more debt for the country?
Well, a lot of the stimulus is going to come out from special purpose bonds. And China's fiscal deficit this year, according to economists' calculation, is going to reach 12%. And this is comparable to 2020, where they were briefly below 12% for the full year. And we think that whilst the deficit number is definitely high, but the fact that the currency is seeing continuous inflow, demand for Chinese domestic central government bonds have been quite strong, the currency is unlikely to be affected by these issues alone. We also note that the banks have been holding back lendings in recent weeks because of the uncertainty of the economy, and therefore the banks are actually flooded with a lot of liquidity. So we think that the banks will take up most of the issuances, and they will be the participant and investor. And we don't think the deficit issue is going to be a problem, at least not in the near-term future for China.
What do you make of the fact that there are no cash handouts that are included in this package? So in turn, how are consumers going to benefit from this plan?
Well, I mean, they announced, in addition to the fiscal stimulus packages, which would definitely bring the construction workers back to work, the engineering companies back to work, and as some of them might have lost their job during the real estate slowdown. And so that is a positive for the consumers there. Secondly, beyond the special purpose bond announcements, there were numerous rebates that's been announced on tax rebates on fees, on some of the tax duties, and also, I think more specifically, on cars. Car purchases have been given a major tax rebate in the recent announcements, and therefore we are seeing that the sector are getting the benefit of selling the same car for a cheaper price, just wasn't the case a month ago. So we think the consumers there will benefit. Okay. But yes, you're right. China is not handing out cash.
What impact does China's current COVID policy have on this package?
Now, what's happening on the ground is you have one person infected in the building may be locked down, but the estates, another 30 buildings will not be locked down. So people in most buildings are able to go to work. So China have adjusted the zero COVID policy, and therefore it's the new, what we so-called the dynamic zero policy. And in this way, we will be able to see supply chain recovery in China, and the economic momentum of the economy will be maintained.
Thank you so much, Jack Siu, for speaking to us from Hong Kong. The Northern Ireland Protocol is a good arrangement with the minimum possible bureaucratic consequences. Those were the exact words of the British Prime Minister when he negotiated the deal more than 2 years ago. Today, Boris Johnson says he wants to fix the agreement because it's damaged trade with the rest of the United Kingdom. Johnson's government has now introduced legislation that would unilaterally override parts of the post-Brexit protocol with the EU. Well, the new bill aims to remove most checks on trade in goods from Great Britain to Northern Ireland at Irish seaports. Goods destined to stay in Northern Ireland would pass through a green channel with no checks, while those intended for the Irish Republic would be in the red lane and would continue to be subject to checks. Well, the legislation would also end the oversight role of the European Court of Justice. Now, the Northern Ireland Protocol was the compromise between Johnson and the European Union to avoid a hard border between Northern Ireland and the Republic of Ireland after the UK left the EU. And it does so by keeping Northern Ireland in the EU's single market while there are checks on goods entering from the rest of the UK. That's effectively created an Irish sea border with inspections and document checks conducted at Northern Ireland's ports. It was also agreed Northern Ireland would keep following EU customs rules and applies EU law on value-added tax. Well, critics say the protocol is causing difficulty for businesses, but supporters say having unique access to both the UK and EU markets is benefiting them. And Johnson's Conservative government says the protocol endangers the 1998 Good Friday Peace Accord, which put an end to decades of sectarian violence on the island of Ireland. Pro-British unionists in Northern Ireland say trade checks created as a result of the protocol cuts them off from the rest of the UK. They're refusing to join a power-sharing government in Belfast with the nationalist Sinn Féin unless the protocol is rewritten. The EU has launched legal action against the UK over its failure to implement parts of the post-Brexit deal it agreed with the bloc. Well, joining me now from Dublin is John McGrain. John is the co-founder and Director General of the British-Irish Chamber of Commerce. Good to have you with us, John McGrain. Thanks so much for your time. So the UK is justifying the bill under the, quote, doctrine of necessity. Do you think that's persuasive enough for the EU?
I think we're in a poor place now. The cascade of events over the production of this new piece of threatened legislation, and it is threatened legislation. Even if it's passed, it will still have to get through a lot of hoops, and it may never be actually applied. But it is an important threat, and it is a great worry now for businesses throughout Great Britain and Ireland, but it's not just businesses, for the communities that they serve through the jobs that they create and invest further in. The use of the word necessity is a legalistic term, obviously, leaving lots of room for interpretation and calibration. The reality is that the greater number of businesses and communities served by those businesses have been getting on with the implementation of the protocol, albeit with some wrinkles. But every new regime, every new formulation of business rules does take time to adjust. And there are ample mechanisms in place to make those adjustments.
Here's the thing. I mean, there have been complaints about excessive, time-consuming, as well as expensive inspections at ports because of the protocol. Do you think that this new legislation, if it goes ahead, if it passes, will it make it easier for traders?
Well, no, as presented, it creates a very troublesome place for traders now on both islands and indeed beyond, because the level of uncertainty has been increased, not reduced. The proposed mechanisms now involving things like traders having to make a choice, and ultimately their consumers ending up being selected to consume products that are made to a British standard on the one hand, or as a total alternative products made to a European standard on the other hand. The reality is the standards are the same, but the provision that things could vary and that effectively suppliers need to choose which regime and regulations they follow is extremely troublesome for business. It is unworkable for business. And the nature of trade on these islands.
John, for the benefit of our international viewers, I wonder if you can just give us a little bit of context and tell us why the protocol has really been a source of tension since it was signed.
People who are upset by the protocol are basically two groups. From the trade point of view, exporters from Great Britain into Northern Ireland, who have been exporting for a lifetime, and understandably so, are not inclined to take the workload of filling in declarations that now have to be completed to simply trade across the Irish Sea from England into Northern Ireland. That's an understandable frustration, but the fact that it has to be done at all is annoying, genuinely. Some people in Northern Ireland who feel, well, we never had that burden on our suppliers before, and this is a problem now because some of them are saying they don't want to supply us anymore. In reality, most traders have found workarounds and alternative sources of supply, and they are getting on with trade. But it is understandable that there is what we call an identity politics issue. There is a cohort, a minority but a relevant cohort, who have a, if you like, identity politics objection to the notion that they can't trade without formality in the way that they did previously with Great Britain. There is one area, in fact, just two areas that would solve most of this. Most of the issues of most of the compliance issues here are around the food sector. There are some others in engineering and such like, but the biggest issue is in food because it's about food safety, human health, and animal welfare, and the standards for that are extremely high across both islands and beyond. The issue could be solved about the need for checks on the, if you like, compliance and the safety of food products, food imports, food exports from these islands, and the supply chain issues, things like animal feed, as well as animal welfare in its own right, and things like animal and veterinary medicines. Right. So the entire supply chain is very secure. The signing of a veterinary agreement between the two nations with the blessing of the EU would take away 99% of those checks.
All right, let me just jump in there, John. Just very briefly, if you may. I mean, looking ahead, what do you think is going to happen? Do you expect a trade war with the EU?
I can't rule that out. I certainly hope it doesn't happen because it would mark an escalation from which it would be very difficult to roll back. But there's no doubt about it. The threatening of this new legislation by really a minority faction in Westminster has raised the stakes. And it is understandable that having signed an agreement and now saying we want to go away from our own agreement, that the EU, the other counterpart to that agreement, will say, well, that's not an inconsequential matter, and that there will be sanctions on the EU side. Okay. And that is a dangerous state of affairs. It could escalate dangerously very fast. We need to get back to the negotiating table. And the second formulation that I mentioned is a thing called the Joint Committee, which already pre-exists and needs to be activated to deal with these practical issues and take it out of the political storm.
All right. Thank you so much, John McGrain, for speaking to us from Dublin. Thank you. Japan reopens its doors to travelers. The U.S. drops COVID-19 test requirements for airline passengers, and restrictions are eased around the world. Travel is finally getting a taste of a comeback after 2 years of industry devastation brought on by the pandemic. Destinations around the world have welcomed nearly 3 times as many arrivals in the first 3 months of this year compared to the same period in 2021. And the World Tourism Organization says global arrivals have increased by 130% in January compared to the same period last year. Destinations worldwide welcomed an estimated 117 million international arrivals compared to 41 million in the first quarter of last year. And tourism saw a 182% year-on-year increase between January and March. Europe and the Americas led the recovery. Europe welcomed almost 4 times as many arrivals as in the first 3 months of 2021, while the Americas' arrivals more than doubled in that same period. So people are so eager to travel that they're buying flights and booking hotel rooms, even at very high prices. A return economy class ticket between Hong Kong and London, for example, on Cathay Pacific Airways at the end of this month is more than 5 times the cost before the pandemic, for example. While Marriott hotel chain says that over Memorial Day weekend, the company's revenue per available room was up about 25% in 2022 compared to 2019. Let's discuss all of this. I'm joined by Caroline Bremner. Caroline is the Senior Head of Travel Research at Euromonitor International. She's joining us from Scotland's capital, Edinburgh. Welcome to the program, Caroline. So what do you think is driving the rebound in the travel and tourism sectors, despite that rising prices of tickets and hotel rooms that I've just been talking about?
Well, I think, as you mentioned, it's very much driven by consumer demand. That's been very pent up during the pandemic. So we've had 2.5 years where, consumers were confined to their houses. They were under travel bans and restrictions. And only very recently have governments started easing back on those. And currently there's about 46 countries around the world that have no restrictions at all, according to the UNWTO.
Right. So let's just talk a little bit about the high cost of traveling, however, because we are seeing escalating costs. And these costs are being passed on to the travelers. Any way that can be avoided at all?
Well, what we have seen is, global inflation doubling since January this year. So this is, very worrying for consumers as well as businesses. We've had the shock of the war in Ukraine that is causing, inflation. We've got, disconnects with the supply chain, energy prices and food prices rising. So yes, at some point, companies can't keep absorbing those costs and they do need to pass them on to consumers. So yes, as you mentioned, there's very high airline ticket prices, but at the same time, there's so much pent up demand because consumers spent 2.5 years without being able to travel internationally. And so, you've got this sort of really strong demand surge. And the problem is that, the industry itself is not able to meet that because, during the pandemic, they had to lay off workers. So now we've got a situation where there are staff shortages and the supply isn't able to meet that very strong demand.
Interesting. Okay. And look, you outline a bunch of challenges. You talk about the Ukraine war for one, inflation was the second one, and this issue of staff shortages. Do you think that all of this is going to undermine confidence in the global travel market going forward?
Well, when the war in Ukraine started on the 24th of February, yes, this increased the levels of volatility in the global economy. And of course, it has caused, further volatility, especially in Eastern Europe. But there hasn't been that sort of long-term sustained drop in interest in demand. And, there were fears at the beginning that the Americans would be put off from coming to Europe. But actually, the very latest data from the National Travel and Tourism Office shows growth of 700% from America to Europe. And of course, within Europe, there are no restrictions in place, well, very few. And so that means that, there's very strong interregional European demand. So, that demand is sort of localized at the moment. And of course, the war in Ukraine is challenging, but at the same time, it's not having this sustained long-term impact on overall demand for travel.
So when do you expect a sort of full recovery for the industry? And do you think this is going to be a bumper year?
Well, without doubt that 2022 is going to be a stellar year for travel and tourism. We really are seeing that this is the year that the rebound is really going to take place. And, at Euromonitor, we're predicting, growth of 84% for the full year. Obviously, the level of decline that we saw during the peak of the pandemic, we saw the industry collapse by 75%. And then there was only minimal growth of about 1% last year in terms of international tourism spending. So the recovery itself to those pre-crisis levels is going to take at least 8 to 9 years. So we really are looking at a long, drawn-out period of return to recovery and to reach those peak levels that we enjoyed beforehand.
Okay, thank you so much, Caroline Bremner, for joining us from Edinburgh.
Thank you.
And that's our show for this week. Get in touch with us by tweeting me at DeadeenAG. Do use the hashtag AJCTC when you do. You can also drop us an email. countingthecost@aljazeera.net is our address. But there's more for you online at aljazeera.com/CTC, and that'll take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. That's it for this edition of Counting the Cost. I'm Deadeen Abu Gheda from the whole team. Thanks for joining us. The news on Al Jazeera is next.